Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is John Allegas. And John is the co-author of a book. It's called Getting Started in Employee Stock Options. This book is published by Wiley. You can get it on Amazon or at your bookseller. He writes an email newsletter called Truth in Options. He's the owner of Truth in Options. He was formerly a member of the Pacific Stock and Options Exchange and the Chicago Board Options Exchange. John co-founded Options Research, which was the first analytical service to provide theoretical option values to market makers and the general public. For years, he was considered one of the leading options market makers in the world, having created many of the trading and hedging strategies that are used today. In his younger days, John was a pitcher in minor league baseball. And so his team was the Reno Silver Sox. John told me that his first bunkmate was Ray Fosse, and I understand Ray's an announcer for the Oakland A's.
Yeah, he was a famous catcher.
Okay.
And there was a big collision at home plate between Ray Fosse and Pete Rose, which is famous.
Oh boy, classic, huh?
And,
okay.
That's not to say that's what made him famous, but anyway, we were roommates in Reno.
That's great. And his first minor league baseball game was against the San Jose Bees right here in San Jose, Silicon Valley.
That's right.
In California. It wasn't Silicon Valley back then. It was the Valley of Heart's Delight, the prune capital of the world, right? Anyway, just to let you folks know, we are talking about options subjects. So I also have a book. It's called Secrets of Tax Planning for Employee Stock Options, 2009 edition. And that's also available at Amazon.com. Today, John and I will be talking about hedging strategies related to employee stock options. We have another program that we talked about basics for employee stock options. You can find that at our website, which is financialinsiderweekly.com under past episodes. And so today we're actually going to be talking about some investment considerations, particularly about hedging. Now, as we get started, this is merely an introduction to a complex topic. You should seek advice from a tax advisor and an investment advisor, and preferably an investment advisor that understands hedging strategies. John has put many years into studying this and a lot of effort into writing this book to try to get information out to the public. So don't think that we can cover everything here in this short interview. We're just going to hit some highlights. All right, John, let's get started with our questions.
All right, Michael, thank you for inviting me.
Yeah, it's a pleasure having you. By the way, John is my biggest traveled guest. He's come here all the way from Louisiana. So anyway, I'm really thrilled to have him here with me. All right, John, what is the objective of hedging strategies for employee stock options?
All right. Employees, whether they're managers or executives, are granted options and restricted stock and ESPPs for the purpose of aligning the interests of the employee or executive with the company shareholders.
Yes.
Okay. So in addition to their cash compensation, they give them equity compensation. So the employee, whether he's an executive or a manager, he gets loaded up with equity compensation. There's all forms of it. And there's a theoretical value of those options, and there's theoretical values for restricted stock too. But as the stock moves around, those values change. And of course, since his interests are aligned with the stockholders, he wants the stock to go up because the restricted stock and employee stock options, whether it's incentive stock options or non-qualified employee stock options, they go up too. That's the idea. Now, of course, we all know they don't always go up. Okay, sometimes they just sit there, sometimes they go down. Sometimes they go down a lot, a little, and sometimes up a lot, a little. Okay, now there's a lot of risk associated with holding those positions, and it's very seldom addressed because people are generally risk averse. Okay, but they give them these options, and they're holding them, and it may be the case that they have the right to buy 10,000 shares of stock at 20. It has a good value. It has perhaps $75,000 or $75,000 of theoretical value. Now the first slide shows in the blue the theoretical value of some options at the time they were granted and as they move around, making the assumptions about the stock that are in the block. The block assumes a certain volatility, certain expected time remaining, certain interest rate, and no dividend in this case. Now, if you made different assumptions about volatilities, expected time remaining, interest rates, or dividends, it would change the theoretical value of those options. But now, as the stock moves around, and the initial graph shows an assumption when the stock is, you have the right to buy employee stock, You have employee stock options give you the right to buy the stock at 20.
Yes.
Okay, and the assumption is that there's 6.5 years expected time to expiration, although the maximum contractual life is 10 years.
Yeah.
Because people generally don't hold them to the end.
Okay.
And either they quit work and they're forced to exercise, or they, for whatever reason, exercise early. So that influences the value. The interest rate influences value. The dividend influences the value. The higher the dividend, the lower the value. The higher the interest rate, the greater the value. And the higher the volatility, the greater the value. Okay, so the blue graph illustrates how those values change as the stock moves around from 20 to 10 perhaps, or
No,
20.
is this the slide that says theoretical value components?
No, that's the first slide. It's the blue slide. It says Black-Scholes.
Okay, so we should still be on the Black-Scholes theoretical value.
Right,
Okay.
right. But the second slide, why don't you show the second slide, please, now? Okay.
Go ahead.
Uh,
You're not going to see it, John,
and-
so you're going to have to just go for it.
Okay, so the second slide is nothing more than the first slide, except that I'm separating the two components.
Okay.
Okay, now the components of the value of those employee stock options consists of what we call the intrinsic value plus the time premium or the time value.
Or is it
Okay,
theoretical value?
okay, so the full amount is the theoretical value.
Oh, okay.
Okay, the theoretical value consists of the two components, that is the in-the-money amount and this theoretical value, which is called the time premium. So
Okay.
add those two together and you get the full
Value.
theoretical value.
Okay.
Okay. Now, at grant date, since the exercise price is generally what the market price is, there is no in-the-money amount. So the full value at the grant date is theoretical, and it's
Yes.
time premium and time value.
Yeah.
Okay. Now, the third graph shows what happens when you exercise prior to expiration.
Mhm.
Okay. You lose the time premium that's remaining, or the time value which is remaining. The time premium and time value is exactly the same thing. And then you receive taxable income equal to what we call the intrinsic value, which is the in-the-money amount. Okay, so if you have
It's the excess of the fair market value over the option price.
Right.
Yeah.
So if you have the right to buy the stock at 20, if you have the right to buy 1,000 shares at 20 and the stock's trading at 40, and you exercise, at that time, you will receive compensation income equal to the difference between what the stock is trading for, which is 40 here,
Yeah.
and 20, which is $20 times 1,000 or $20,000.
Yeah.
Okay, but there's still a little time premium left that you forfeited. Okay, so what we try to do is say, try to avoid the early exercises if you want to manage them right. Okay, but avoiding early exercises and just holding and hoping for the best is fraught with a lot of risk.
Mm-hmm.
You see, so if you're risk averse, is there something you can do within the rules which doesn't cause you to pay an early tax and which doesn't cause you a forfeiture of that time premium? And that time premium can be quite a bit of the full value if you have a high volatility and you got high interest rate and no dividend and a substantial amount of time remaining, and the stock is not trading too far away from what the exercise price is. In other words, if you have the right to buy the stock at 20 and it's trading at 30 and there's 3 years to go and it's reasonably volatile, there's a lot of value in those options that you won't get if you exercise that early.
Mm-hmm.
Okay, you just throw it away. Effectively, it goes back to the company.
Mm-hmm.
Okay, and so what can you do within the rules other than just make these premature exercises and sell? Well, within the rules, you can go to the exchange traded options markets. And it's just like if you're a farmer and you know your corn is going to be coming and you want to make sure you get a good price because you think the price is high, you can go sell futures or actually options on corn, which essentially hedges your position. Mm-hmm. You could do the same thing with employee stock options and using the exchange traded calls, or in some cases you might want to decide to buy puts. It depends upon what type of risk you want to reduce. If you want to reduce the risk of extreme moves downward, you buy puts. If you figure that, well, I can just sell some exchange traded calls by doing what they call writing calls, or it's essentially you're selling some of the effectively you're selling some of those calls that those employee stock options that you're granted. But nevertheless, that's a way, and it's in my view a superior way to manage the risk and get the maximum for your employee stock options and even restricted stock or other forms of stock. So most advisors promote a strategy, and that strategy is to make the early exercise, sell the stock, and take the residual amount after forfeiting the time premium, paying the tax, and diversifying with that. Mm-hmm. That's what most wealth managers tell you. They don't explain it the way I did it because they're going to ignore this time premium that you're forfeiting back to the company, and they're not going to even probably mention the penalty associated with paying the tax maybe 3 or 4 years early. Mm-hmm. Okay, because but nevertheless, there is a strategy of hedging, which involves selling calls, exchange traded calls, or buying puts, sometimes together, and you kind of have to be familiar with how to do that. But it's not that difficult. You just open an account at Schwab or Merrill or some firms. You can actually do it on your online for very low commissions. Mm-hmm. And so, nevertheless, that's what those graphs illustrate. The time premium that's forfeited, the taxes that are paid, and what you try to do is avoid that, keep that to a minimum. You want to hold them to the end. You want to do like Steve Jobs did. Mm-hmm. He exercised a bunch of options that he had at a price of 5 when the stock was 95 or something like that. So he held them for the stock to go from 5 to 95. He exercised them on the last day. In other words, he held it for 9 years and 364 days. If you look at Larry Ellison from Oracle, if you look at John Chambers and James Dimon and other big-time executives, they're managing those things right. I don't know everything they're doing. I don't know whether they're hedging, but they're holding them to the end. And that's what I say. Try to hold them as long as you can, unless you just need the money.
Yeah.
Okay.
Yeah, well, there are other reasons why, and people have their own personal goals and
that's right.
and what have you. So